Mortgage rates ease. Will they continue? Hey, this is Dave with the Bolduc Group, powered by EXP. Welcome to my weekly real estate market update. Today's September 1st. Happy September, and hope you're all looking forward to a great Labor Day weekend. I do want to apologize for missing the video last week. Let's just say I was with some friends over in Dublin at the Navy Notre Dame game, and then I was over in Germany after that, and we'll just leave it at that. Anyway, jumping into the key Connecticut market stats. We got 4,163 houses on the market today. Now, that's about what we've been seeing, about 4,100, and I don't think we've hit 4,200. So about 4,100, pretty normal. 284 new listings over the last 24 hours. We had 3,684 closings in August. Now, it's only September, so those numbers are going to go up a little bit as more data comes in. We should know a pretty solid number by next week. But that's against 3,400 in July. So we did see more closings this month. And based on those August sales, we're at about 1.1 months of inventory. So we're still in that very low inventory position. Houses are coming on the market, and they're also selling. Demand is staying pretty decent, pretty strong. So we got some key dates here. There's been a few big reports over the last couple days. PCE that came in flat month over month. That was what was expected. The unfavorable news was that the year-over-year number was 3.3% up versus 3.0 the month before. So remember, the PCE, which is the Personal Consumption Expenditure Index, that's the Fed's favorite inflation report. That's the one they're really watching. And we're seeing inflation go back up on a year-over-year basis. While it's not the highest that we've seen, it's certainly over the 2.0% target that the Fed has. Next thing is the jobs report for August came in. There's 187,000 jobs added. That's well over the 170,000 that was forecasted. So the job market remains stronger than expected. Looking a little bit deeper into the report, we saw a couple of things. So first, unemployment went from 3.5% up to 3.8%. So is that more people coming into the market, less jobs? I'm not sure, but what we're seeing is the unemployment rate has gone up. At the same time, the ratio of jobs to unemployed people went from 1.54 to 1.51. So what does that mean? That means that there's 1.5 jobs for every unemployed person. There's some interesting impacts that I'll talk about in a second. Personal spending also remained strong. Household spending in July went up 0.8%. So you're probably saying, Dave, look, that's a lot of numbers. What does that mean? Why do I care? All right, so that's a great question. Bottom line here, inflation is definitely sticking around, and it may be going back up. All right. At the same time, the economy is adding more jobs than it's expected, which indicates the economy is still relatively strong. May not be as strong as it was before, but it's still relatively strong. More jobs than unemployed people means that those people, both the unemployed and people that are employed, have leverage to try to push up wages. And we're seeing that. We are seeing wage growth. And with more money in people's pockets, that means there's an opportunity to spend more. And we're seeing that as well. Personal spending, like I said, was up in July 0.8%. And as people spend more with a relatively stable supply, as demand goes up, supply stays the same, prices go up. What's another word for prices going up? Inflation. So there's a potential to really fuel inflation with what's going on in the economy right now. We're seeing this in the real estate market as well. People told me in 2018, prices are way too high, the market's going to crash, it's all over. We never saw a crash. Prices are up 40 to 45% since then. And demand continues to be relatively strong. Now, supply is way down and demand's way down because of the high interest rates, but demand is still stronger than supply here in Connecticut. And I continue to hear people saying that the housing market's going to crash. The data, it just doesn't bear that out. It doesn't support that claim. Unfortunately, that's a personal desire, and the market just doesn't care about personal desires. It looks at what the actual market conditions are. So we can expect the real estate market to remain the same until either demand drops or supply goes up. And neither of those is expected to happen in the near term. So talking about the primary mortgage market survey, we're off recent highs, but not by much. The economy continues to show resilience, like we talked about. And as I said a few weeks ago, the market doesn't seem to really trust these inflation numbers easing off. And they may have been right to make that assumption. The Fed meets again in 3 weeks. We've had a bunch of favorable inflation reports and other economic reports, but over the last couple weeks, that's changed a little bit. The market right now thinks there's about a 1 in 10 chance that the Fed is going to raise the Fed funds rate. If the CPI report and the PPI report, which are coming up in a couple weeks, are not favorable, if they show inflation's going up, I'm willing to bet those odds are going to shift more towards another rate hike. Mortgage rates are going to continue to be elevated until the market is convinced that inflation is going away and the Fed starts to lower the Fed funds rate. Even then, mortgage rates, they're probably going to remain in the 5% range for the foreseeable future. I hope this is helpful. Questions and comments, feedback are always appreciated. Have a great day.